Today we're on location in Carmel, Indiana, trying a new format. And today it's another case study. This time it's on IQVIA's fourth quarter 2025 results. The company reported a week ago, and the stock saw a significant dislocation in its share price, on the print and since. And it was a mixed quarter. They beat on revenue, they beat on some other metrics, but they missed on EPS. And the issue is they reported a pretty solid backlog of almost 33 billion, up 5.3% year over year. And book-to-bill was about 1.18, which was not quite where you want it to be, about 1.2 to show accelerating backlog growth. But the issue is this. The headlines are saying that AI investment and AI trends are hurting IQVIA. In my view, the reason the stock saw this significant dislocation has nothing to do with AI. It's actually a structural issue around the revenue visibility of the company being driven by more increasing clinical trial complexity and more specialized patient populations. So we're going to do this in two videos. So in the first video, what we really want to get to is the heart of the matter, which is this idea of the fiscal year 26 revenue visibility analysis, because we think this explains exactly why we've seen the share price dislocation that we saw in IQVIA shares. So what we have here is we look at 2026. We're looking at the nearest 12-month conversion rate, which was about 25.4%. which gives us about 48% revenue visibility. And there's no gap to a year ago because in 2025, our conversion rate and revenue visibility were the same. So there's no gap between year over year. Now, the issue starts to happen when you look at the 5-year average, when the conversion rate was 26.8 and 51% visibility. That implies that there's about a $450 million revenue gap just based on where we are today to the 5-year average. Now, when you look at the 10-year average, that conversion rate was 28.2% and revenue visibility was 54%, implying a revenue gap of almost $1 billion. In our view, this is what's really driving the dislocation in the shares, because we think that there is a structural change afoot with the increasing complexity of clinical trials and more specialized patient populations. And to close the loop on this idea of AI trends and AI investment hurting IQVIA, our view is this: when you consider Medidata Solutions and Veeva Systems, two of the most prolific disintermediators of clinical trial technology, people thought they might put CROs out of business. That has not happened. That has not changed. They have been only additive to the industry and improving the way therapies are created. Our view is that AI is additive. It is not going to put CROs out of business. Maybe it changes their business a little bit, but we think it's more of an additive tissue than something that's going to disintermediate CROs. In part two, we're going to walk through the idea of how clinical trial complexity and specifically patient populations are driving this structural change around revenue visibility. Thanks for watching.